Are we going to go back to QE, open market? That's a legitimate question, and the odds are that we will. And if that happens, then we are coming very close to fiscal dominance, to where the Fed is under enormous pressure. And the way I describe it is, it becomes a new mandate. So we have price stability mandate, we have maximum employment mandate, we have low long-term interest rate mandate, and now we have make sure the Treasury market is liquid and functioning fully. And if that's your new mandate as the Fed, you're going to print money to buy on the margin that part of the fiscal deficit that the foreign and private sector doesn't take up, so that you peg interest rates below what they otherwise would be. And that is a real risk that the Fed and that the country is going to have to face, I think, in the not too distant future.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Will the Federal Reserve cut interest rates when it meets again in mid-December? Wall Street's been whipsawing the odds back and forth over the past few weeks. To address that question, plus the even larger one of who's likely to replace Fed Chair Jerome Powell when his tenure ends in the spring, we're fortunate to welcome back to the program Dr. Thomas Hoenig, former CEO of the Kansas City Fed, former voting member of the Federal Open Market Committee, a former director of the FDIC, and now a distinguished senior fellow at the Mercatus Center. Tom, thanks so much for joining us.
Thanks for having me. It's always good to talk to you, Adam.
Thank you, Tom. It's a pleasure and a privilege to have you back on the program. All right. Well, look, like I said there in the intro, there's actually a lot to talk about here. So why don't we just dive right into it?
Sure.
Do you think the Fed is going to cut this month? If so, by how much? And whatever you think their decision is going to be, do you think that's the right call?
Well, to answer your question, I would first say I suspect, I'd give it better than 50-50 odds that they will cut. There's a lot of pressure on them to cut among some of the leading members of the committee, specifically Governor Waller and Governor Myron, as well as Governor Bowman. So you have three votes that are almost dead certain to cut. The discussions that went on last week, or shall I say, some of the speeches that, say, John Williams of the New York Fed, who is a voting member, gave, were very dovish in a relative sense. And so he would be a possible fourth. After that, it gets a little more difficult. Powell is, of course, holding his cards very close to his chest, since he doesn't want to be on the losing side of the vote. I think he's probably counting votes. But given the signal that Williams gave, and he and Williams and the chairman are usually pretty close in their votes in alignment, that gives me a hint that the chairman would prefer to cut. So that leaves the other members, and I think if you read some of the dialogue going on, or the writings going on right now, the members like Austin Goolsbee seems to oppose a cut. The St. Louis Fed seems to be wanting to hold off on any cuts. The others on the committee are Unknown Jefferson, who's the vice chair, I think would stick with the chairman. And so you when you get all done with it, you could have a vote of 7-5. Now that's unusual. That would be a very unusual vote. And if it becomes clear if it is 7-5, it becomes clear to the 5, you may have one or two join it. So it's not so close. So that's the intrigue of the FOMC this week. And I'm betting on it going towards a cut. There's going to be a lot of pressure coming from Treasury, a lot of pressure coming from the White House for a cut. You'd like to think you could ignore that, but people are human, and I think it'd be very difficult. So that's why I'm kind of the view that it goes towards a cut. Now, what do I think? I'm pretty much of the mind that they should not cut. And I base that on a couple things. Number one, The economy is doing reasonably well right now. Even though the continuing and the Fed is focused on the labor market, so the continuing claims numbers, which are showing constant increases, are a worry to those who want to have the cut, even though initial claims are staying rather steady. That means people are having to look for jobs longer. So that'll worry many of the members. But I put that against the fact that still the unemployment rate is relatively low, still in the 4.1, 4.2 range, and that's a very favorable number. That's number one. Number two, the inflation numbers are still 3%. That's well above the target of 2% and well above price stability, which would be closer to zero. So you still have a lot of inflation in the system, and it's not coming out. It's been that way for a year, seems to be holding at that level, and I think that is something that leads to trouble if they don't address that now. And the reason for that is the other factor in this picture that is not talked about by members of the Open Market Committee, but are important numbers, and that is the growing national debt and the growing deficit, or the large deficit that is being incurred at the rate of $2 trillion a year. That puts extra supply into the securities market, and therefore, given the limited demand, that puts upward pressure on interest rates and makes the Treasury really want the Fed to cut to help buy some of that debt. So there's a lot of things in play that on balance lead me to think they will cut when in fact they probably should not.
Okay, all right. And when you say you think the Fed might cut, you're talking about a 25 basis point, nothing bigger than that, right?
I would be surprised. I would be shocked if it was bigger than 25 basis points.
Okay. And how much of a factor at this FOMC meeting or this Fed meeting is the fact that they had the government shut down, and so a lot of the government reporting agencies weren't reporting data for the past month and a half. Is that a really big deal here? Is the Fed kind of flying blind, or do they have so many other different data points available to them? It's not that bad.
Well, I don't think it's enough to cause them to make an irrational choice going forward. I think the information they have is adequate for them to make a choice. There's a lot of politics in this choice, though, that I think is perhaps even more dominant at the moment. Now, I say that, but the other thing is, I think I'm of the mind that this month-to-month data and the gyrations that they go through every time there's a new data point, which is always preliminary, it's always revised.
Mm-hmm.
So I don't think they're handicapped that badly, given the volatility of the data. There's been a great deal of discussion about basically the lack of good survey data because people are not responding to the surveys as they used to. So there's a lot of uncertainty around that data regardless. And so I think if they were wise, they'd say, well, we're going to take longer term views. And we do know that at the moment, the economy is relatively stable. We do know that the unemployment numbers are relatively favorable. We know there are risks there, but we also know that inflation is above target. And if you look at the data coming out just on the initial Christmas numbers, you know that the demand is still pretty strong, and therefore the economy is probably riding at a pretty stable or strong level. And that is why I'm more convinced that you really don't need to cut rates at this time. You need to focus on allowing the inflation numbers to come down. Okay.
So I've got a bunch of questions that I've planned, but you're pulling me off them into a couple different directions here. So
sorry.
No, it's all good. It's all good. But let's go through this progression now. So first off, because you have sat at the table and you have looked at the data that the Fed looks at, there have been a lot of criticisms of the government generated data, and this is before the government shutdown. So I'm sure you've heard the skepticism of the validity of the BLS data, especially around jobs. And this was a conversation that was beginning to be had before the government shutdown, but during the government shutdown, people had to rely much more on these alternative, and in many cases, much more comprehensive and much more real-time data sources. And it raises the question of, well, why are we still relying on these government-generated, sort of imperfect, highly imputed forecasts, or not forecasts, but statistics, when we have the ability to go direct to the source in real time. It's now 2025. I mean, we've got the internet, we've got the blockchain. I mean, we can get
Yeah.
real specific. So rather than rely on the BLS payroll data, why don't we just look at like the ADP data, which just is the actual paychecks, or the Treasury tax receipts. There are alternative sources out there. We now have a different source for inflation with Truflation. And I'm not saying that that's the be all and end all, but it is another highly comprehensive way to collect this. So where I'm going with this is there the opportunity here to reevaluate the data that the Fed and the world looks at to measure the economy, and perhaps migrate from maybe a system that worked okay in the past, but isn't really ready for, or isn't, what we need in the modern era, and come up with some better, more modern ways of measurement.
Well, I think that's a very legitimate point. I think that, first of all, I would still want the BLS and the Bureau of Economic Analysis to be in this business. They're relatively speaking, they're a trusted source. Private sector also has its errors and its mistakes and its biases. So I would like to see. I want to make sure we stay with hopefully an impartial source for this data. But I do think that the source needs to be modernized, needs to recognize that the technology is here that would give us better, more, shall we say, deeper is a better word, data, more reliable data with the technology. And I think that should be a primary objective of the government source as well as the private source. And I do like the idea, frankly. I've always liked compared ADP against the Bureau of Labor. You get different kind of inputs and outputs to compare and to think about, because no matter what it is, it's a survey. It's an estimate, and estimates are affected by all kinds of factors. So having multiple sources that you can sort through is, I think, a long-term advantage for policy making. And then finally, you have to, when the policy maker has this data, they have to make objective choices and have to be careful about what influences those choices. So that's the process. And I think we do need to upgrade it, modernize it, and I think provide the public with better outcomes.
And what is keeping us from doing that? Is it just the inertia of a big government bureaucracy? Are there parties that are happy to have data that's a little bit squishy? What's your thoughts?
I think, frankly, inertia is a very powerful force. And I think inertia is part of it. We've always done it this way. It's hard to change. And maybe with the shutdown, and maybe with the fact that the survey data is becoming obviously more unreliable to the public, that will force some change and force some improvements. I genuinely hope so, and I'm confident it can be done. I've just seen the technology. It's so impressive how quickly the technology is moving forward, that these sources have to keep up with it. They have to use it and begin to, I think, benefit from it. So we should do that.
Okay. On a sort of related note, you talked about how inflation, as measured by CPI, is still at 3%. So, somebody might say, well, that's only 1% above the 2% target of the Fed. And of course, a
Mhm.
mathematician would say, well, that's 50% above.
Yes, I would
So,
certainly do that.
yeah, exactly. Um, Now, I've heard the argument from people uh, that, well, yeah, it's at 3% right now, but if you look at the more real-time data sources we have, they suggest that housing is cooling, and housing shelter makes up, it's the biggest component by far in the CPI calculation. And the inputs to shelter in the current CPI calculation are very lagging. And so their argument is just, they've got a fairly high degree of confidence that shelter is going to start pulling down the CPI almost regardless of what happens with the other components over
Mhm.
the coming year. Do you have any strong feelings one way or the other on that?
Well, I understand the fact that the housing prices are coming down slowly
Yeah.
from very high levels. So I wouldn't get too excited about the fact that they've come down a little bit.
Yeah. And
And
just to be clear too,
also,
housing and rents, but yes. Yeah.
yeah, housing and rents applied. And I think um, I'm mindful of that, but I'm not prepared to say that's going to dominate as we go forward. First of all, housing prices are affected by, as you well know, a variety of factors. But housing costs, the cost of construction is not coming down all that phenomenally. Um, the goods prices for lumber and so forth of tariffs, those are still going to be elevated. And so moderated prices not the same as returning to what prices were 2 or 3 years ago. I would also point out that we talk about inflation coming down, but if you think about the accumulative effects of inflation at 2%, 3%, 2.5% over 3 or 4 or 5 years means people are paying much higher prices
Hmm.
ultimately. And then you have to compare that to what incomes are doing, and medium real incomes are barely keeping up with those price increases. So the question is, are we really better off? And I think it's going to take a while for people to say, I'm caught up again, given this very high price environment that we've suffered through for the last 4 to 5 years. So yes, I want inflation to come down. Um, I want it to be 2% or less uh, over time. But we're not there yet. We're still at 3%. We're still 50% above. And if you keep 3% inflation going for another 3 or 4 years, people are going to have a hard time keeping up uh, still. So let's not get too excited about the fact that inflation is still 3% and not rising, or still 3% maybe coming down to 2.8%. We still have an inflation problem, and that should be our focus as we go forward. Understanding that it's a dual mandate and that employment is important. But I will tell you, in the long history of economics, if you don't have stable prices, you don't have strong employment over a systematic time line. We've learned over and over again. So get the inflation under control, keep it under control, and let employment adjust and remain at a relatively low level of 4.2, 4.3%.
Okay, so I want to get to in a moment to what you mentioned there about how there's a good chunk of the population that is kind of barely hanging on, right? To your point, their wages have not increased enough to
Yeah.
match the increase in overall inflation we've seen over recent years. Um, but what I hear you saying is look, in the battle against inflation, you got to make sure you have killed the inflation dragon before you walk away from the battlefield, and that's the most important thing we got to do. We got to make sure that that dragon is dead before we really start turning our attention elsewhere. You're nodding a bit as I'm saying this, but is that, I know it being simplistic, but is that more or less accurate?
That is accurate. I think 3% inflation is not low inflation. It is, the cumulative effects are enormous, makes it more difficult for that portion of the population who do not have a strong market position to keep up. And I think it does a lot of harm. It does a lot of creates social unrest. And those are all things that have a price tag on them in the long term. And so let's focus on that, get it taken care of. And I don't mean shock the economy, but I mean, don't lose sight of it. I've heard more people argue over the last 6 months about, well, maybe 3% is maybe that should be the target.
I think a lot of people really suspected that's what the narrative was going to go. Yeah.
Yeah. And that is a concern to me that we've gone that road before, and it's turned out very badly for the American economy and for the American people.
Okay, so I'm not disagreeing with you at all, Tom, but trying to channel the argument of some of others here, which I also sort of understand their logic, which is, sure, hey, if we think that the tide has turned, almost sort of the Bugs Bunny, Wile E. Coyote, the coyote he's still in midair, but we know that gravity is going to take over, right? Their concern is, okay, look, housing's going to start pulling down that CPI number in and of itself, but also there's a growing preponderance of data here that shows that this economy, which I think to use the word you used was, looks like it's doing reasonably well. It looks like it's doing reasonably well from a distance on average, right? Meaning there's like K-shaped economy. There's a top 20% that's doing just fine, and they're keeping the averages looking good, but there's a bottom half of the K made up by the majority, let's call it the bottom 80%, that's increasingly struggling. And we're seeing lots of signs that those people are having trouble keeping up, as you mentioned, but we're seeing delinquencies really starting to skyrocket here on debt, which obviously, will, if left unchecked, bleeds into defaults. And there's just a lot of data points we could probably spend this whole hour talking about how that bottom 80% is maybe falling further and further behind. And there's even some signs that top 20% may be starting to think about cooling their purchasing. And so the concerns of these other people is, hey, we might get to a point where we start bringing inflation down, but maybe things go a lot lower than we want, meaning, just overall consumer spending starts going down and companies start laying off people and you get that vicious cycle here. I understand your point of view, which is get the inflation killed and then figure out the rest. How valid is a worry of this other camp that I just described?
Well, we always worry about that. And it has become a bigger issue really over the last 15, 20 years. And the question that you need to ask then is, why is that? And I think therein lies this, what I call the path of good intentions, but bad outcomes. The path of good intentions are we want people working, so we lower interest rates to near zero. We create a worsening of the wealth distribution in the economy to where we have this K economy. We have the bottom 50% who's fallen farther behind. Those who have assets and have benefited from this inflation. And remember, it's not just price inflation, general price inflation, it's asset inflation. So those who have benefited from the rise in housing prices, so you lower interest rates and they benefit more. That sounds wonderful to them. So, what are your long-term goals here? And if you keep focusing on the short run and good intentions that have short-run policies that turn out bad in the longer run, are you doing anyone a favor? And I think it's imperative that the policymaker understand that what you want to do is raise the income for all participants. And when you bring interest rates down with all the right intentions to close to zero, that you stimulate the economy and you create a new kind of asset inflation and you create goods inflation for, you keep talking about housing, but housing inputs are more expensive. Groceries are more expensive when you inflate the economy and you allow it to continue, and the distribution of income becomes worse between those two groups, you've actually undermined your own goals, your well-intentioned goals. So I'm saying let's focus on getting a couple things, getting our economy on an even keel, getting prices to where they're not rising at 3% or better, or even 2.5% or better, that they are much more stable in the long run. And with that, you improve the broad population's welfare, not just the top, by having asset values increase and incomes for those who are already well compensated growing further. So those are the sorts of things you have. So, and what's behind that? I mean, one of our greatest challenges that no one talks about, and the Fed refuses to talk about, is the fact that we have this huge national debt continuing to grow, putting pressure on the Fed to print money to make sure that debt is funded, which creates then more pressure, upward pressure on inflation. So why aren't we talking about some of the real problems? And that is our national goals of spending more than we take in as revenue, redistributing wealth through borrowings rather than through growing real incomes and jobs. Those are the sorts of things that I think don't get enough attention.
All right. Well, they're going to get attention in this conversation. And Tom, I really just want to flag, you are sort of what I consider to be sort of the everyman's Federal Reserve exec. You're the guy who actually cares about the things that regular people care about, right? Hey, how is the majority of society doing? What are our long-term goals for how we want society to function economically? And things about like the debt, right? I mean, you're right. The Fed hardly ever talks about that. You're a guy who's actually waving a warning sign on this. And again, very famously, I don't need to tell you this, but I'll remind the viewers or let the viewers know that don't know about this. You developed what I consider to be a very respectful notoriety during your time on the FOMC for, at the time, setting the record for the largest string of dissents against the Fed chair. And this is back when Chair Bernanke really wanted to, was doing QE or making, coming to the conclusion of doing QE. And you were the lone voice saying, hey, I think this is going to create all sorts of problems. And history has proven you right. And by the way, Tom, when I told folks on social media that I was going to be interviewing you today, a lot of goodwill was sent out to you. People really do love you, and they love that you've been standing for. So a couple of things, and actually relating to Twitter, or X now, I guess I should call it. Here was a response by Tom McClellan. I don't know if you know Tom McClellan, but he's a pretty well-known technical analyst. And he asked me to ask you a trick question, which he said, ask Tom what the statute says is the Fed's inflation target. And you probably know this. I'm going to expand this so folks can read it. But this comes, I believe, from, I don't know if it's in the Federal Reserve Act or not. Upon achievement, this is from 1978. Upon achievement of the 3% goal specified in subsection B2, each succeeding economic report shall have the goal of achieving by 1988 a rate of inflation of 0%. So is it actually true that sort of in the Fed's charter, if you will, the goal is actually 0% inflation, not this 2% inflation that we've sort of just adopted?
Well, people will argue about it, I'm sure. But my own view is that the dual mandate that's reflected by these words is pursuit of price stability. Now, price stability is not 2% inflation. That's inflation stability. And so I have long viewed the idea that we should look for price stability as close to zero, knowing that there are measurement errors and so forth, of course, but that does not excuse a target of 2%. That only excuses maybe being a little bit above 1%, above zero, or a little bit below zero over a long period of time. So that's what price stability is, and I am a strong believer in that. Now, the argument for this 2% inflation target is, number one, that you can't. There's measurement errors, so you don't want to have it be. You don't want deflation, and I'm not at all convinced that modest deflation is any worse than modest inflation. Let's have that conversation. That's number one. But number two, there's this new reason given, and it was given during my time, and that is you have a problem with this effective lower zero bound. And that means that if you have no inflation and you have a slowdown in the economy, if you get the interest rates to zero, well, you can't get real interest rates negative. And I'm saying, there's a lot of research on that area, and there's real balance effects that you have to consider. There's all kinds of other things that can get you through a zero, that allows a zero inflation rate to work very well in your economy. And mild deflation is often and should be a reflection of productivity improvements. And who really benefits from a low inflation? And that's the bottom 50% of the population who works for a salary, doesn't have a big asset stash that goes up with asset inflation. So those are the people you want to have benefit, and let's focus on getting closer to zero inflation. That's the idea behind my views on inflation, and I think that's what the statute requires of us. Requires of the Fed, I should say. Zero inflation.
Again, I think you're getting a lot of people watching this saying, "Why can't we have Tom back on the Fed? Why can't we have more people like him on the Fed?" But I'm sure they're going to feel even more that way after this at the end of this discussion.
Maybe not.
All right. I'm just looking at this whole long list and figuring out how to best bang through it here. Let's start with okay. The Fed is now likely to cut, right? You don't think they should necessarily, but you think that's probably what they're going to do. The Fed, I guess, actually, as of today, since we're recording this in early December, is pretty much ended QT at this point in time, right? They've said they want to sort of freeze the balance sheet here. I'm not sure what's so magical about the current level on the balance sheet. We had all been told back in the Bernanke days that when it was starting to increase from the global financial crisis, it would all come back down to where it was before. Of course, right. Like most things, most government programs that are temporary, they never really are. Let me ask you this. So we're back to cutting. QT is ended. How likely is it that you think the Fed will return to QE, if not in the near term, in the long term? I've heard some people associated with the Fed say, they kind of realized the optics on it were so bad that it's going to be sort of a policy of last resort going forward. Do you believe that, or do you think QT is something we're likely to see sooner rather than later?
Sorry, QT or QE?
QE. I'm sorry, QE.
I'm reasonably of the view that QE will return. I don't know how the Fed will have a difficult choice. Given the size of the national deficit and debt, the amount of government debt refinancing and the amount of new debt that has to be financed is pretty striking. $2 trillion in new debt, $38 trillion debt outstanding. About 9, 10, 11 trillion of that has to be refinanced on an annual basis. Then add the extra 2 trillion. Who's going to buy that debt has to be the next question. And who is that? Well, our foreign trading partners, maybe less so. The demand for dollars is still strong. I'm not saying it's not, but will they be of the mind to buy all this new debt because they want to hold the dollars. And that's a question mark. So will they do it domestically? Will there be more domestic buyers, both from the banking industry, from investors, from pension funds? Will they want to have more dollars and invest in it rather than private purchases of private bonds, notes, and so forth? We have to fund AI investment. So we're competing now for investable funds, and the government has to fund itself. So it's going to pay whatever is necessary. And given the strong supply of that debt and the limited demand, that means there should be upward pressure on interest rates over time.
Which is what the administration does not want to see here, because it makes their job harder. Yeah.
What any administration wants to see not happen is interest rates going up. And yet they're going to feel this pressure. So and the Treasury is going to feel this pressure. We've seen this before. And the Fed will be under enormous pressure to buy that debt. And that means QE. And I think that's a reasonable likelihood. I would say better than 50% chance that we will see open market operations resume and the purchase of government debt resume and add to the balance on the Fed's balance sheet. I may be wrong. I hope I am, but I don't see how that is unless the Fed and the Treasury and the administration and the Congress of the United States come to an understanding that this can't continue. And if they come to that understanding, then I think we can find solutions to address it without having to have QE. Now, that's possible, but under current circumstances, I don't know that I see that on the horizon, to be honest.
Right. It's possible I could jump off a 5-story building and magically land on my feet and be fine, but it's not probable.
Not probable. But I'm in a note of optimism. I'll give you 2 periods actually 3 examples. One is post-World War II. The debt to GDP of the United States was as high as it is today. And the Fed was under a lot of pressure to buy and peg the interest rates at lower levels. And they refused to do so. And through negotiations were allowed to not do so. And the Treasury had to deal with it and the Congress had to deal with it. Now, there were higher taxes and there was spending issues, but they did get through it, and they did actually over the next decade reduce the debt to GDP ratio from that 100% down to half of that.
Right. So, but we were the world's manufacturing base helping the rest of the world rebuild. I mean, there were very different macroeconomic circumstances, but I appreciate the data point. Yeah.
Right. But the fact is they came to an agreement, and it wasn't just the fact that we were the industrial base. It's the fact that we said, we're not going to print money and we're not going to peg interest rates, and you're going to have to find a different solution. It happened again in the middle of the 90s, right? Two adversaries, Clinton and Gingrich. Now, there's other circumstances there too. There was major capital gains, receipts, and so forth, but it was done. So here we have I keep hearing about we're on a horizon of a new productivity gain through AI. And with great productivity gains, there's an opportunity to address your deficit problem in a productive way. Mm-hmm. Are we willing to do that? Yeah. Are we willing to say we're going to do that? So it's doable, but you have to decide to do it, and that's something we've failed to do.
That is a fair point. If AI does deliver upon all of its promises, that is sort of akin to coming out of World War II, where there was a big economic boom that we were heading into. Well, let me ask you this: the president has given lip service to the debt problem during his campaign, right? So he was talking about way too much debt, and actually promised to pay down the debt. Which at the time, I I commented on a little bit of skepticism, but hey, I'd love to be proven wrong.
Yeah.
But of late, he has been saying, um, "Hey, we're making lots of tariff revenue now, and we can use some of that to start paying down the debt." Now, he also said we want to give, checks to households again. So I'm not so sure. I'm not sure how much is going to be left over to pay
Right.
down the
Right.
national debt after if we actually do that. Um, but I guess first and foremost, taking the president at his word, do you see a potential here for government revenues, tariff driven or otherwise, to be used to start actually paying down the debt? Or is that just sort of happy talk right now?
That would be very shocking to say that uh, could be delivered. First of all, certainly tariff incomes. Let's say it's 350 billion a year
Yeah. I
at the
think last
moment.
month it was 31 billion. So that's a fair estimate. Yeah.
Yeah, and so you have that now. The growing debt, the new debt, is 2 trillion. So let's say we get it from 2 trillion to 1.18. Who knows what's going to happen? That's still a lot of new debt to finance.
Yeah.
That's not paying down the debt. And to get to the point where you're running a surplus, you you have to you have to raise well over. Well, you have to do one of two or a combination. You have to stop spending $7+ trillion a year, and you have to take in more than $5 trillion a year.
Yep.
So those two things have to come in line, and we are a long, long ways from that happening. No matter who the president is, and
Yes.
no matter what Congress does, they have a lot to do yet.
Okay, so this was sort of my reaction again when Trump was campaigning, was like, okay, I could see you maybe I could see maybe reducing the deficit, but actually paying down the debt, that's a much taller order. Again, I would love to be
Yes,
proven wrong.
right.
So that's essentially what you're saying, is you could maybe see us shaving a little bit off the deficit here, but that we're still net
Yeah,
adding more debt over time.
right.
So
What I would like to see is just slowing down, you know, the the growth in the debt to where your real economy can grow out of this over multiple years. If we
mhm,
could even get to that level, it would be progress, but we're not there yet even. So
yeah,
that's something to keep in mind.
yeah, yeah. Okay, so let me ask you this. So we have these aggressive fiscal deficits, right? I mean, they exploded during COVID, but COVID's over, and we're still running like we're on a wartime footing here.
Yes,
Um, does that diminish the Fed's ability to influence the system? In other words, does it reduce the impact of monetary policy because you just have this massive fiscal spending that even if the Fed is trying to be a little bit more restrained, like having raised interest rates and done QT and whatnot,
right.
is it being overwhelmed by this sort of reckless continued spending that's just happening on the fiscal side every year?
It's a great question. And one of the way that can be couched is as our monetary policy today subservient to fiscal policy.
Right. And let me
Uh,
interject just so you can address this in your answer. There's the concept of fiscal dominance, which I believe you're
there you go.
familiar with. And a shorthand description of that is um, the debt problem becomes so threatening that the central bank gives up all its other mandates, and its only mandate is to try to just keep the debt affordable, which usually means lower interest rates. Are we there? I mean, is that why we're cutting again here at this point in time?
Well, we are on the edge, I think is a fair way of saying it. And we don't know yet because we have to see what the Fed does. We have to see if there's a awakening within Congress. But yes, we're very close to fiscal dominance, I think, because if you think about it, you mentioned earlier the Fed went on this QE and they were going to return back to normal, normal policy, what I called adequate reserve system or scarce reserve system, to where you're not printing money massively. And we never really left that till we got into 9% inflation, and then we went to this new QT program temporarily. So and now we've stopped QT. We're now in this kind of transition. And the question you raised earlier, are we going to go back to QE, open market? That's a legitimate question, and the odds are that we will. And if that happens, then we are coming very close to fiscal dominance, to where the Fed is under enormous pressure. And the way I describe it is, it becomes a new mandate. So we have price stability mandate, we have maximum employment mandate, we have low long-term interest rate mandate, and now we have make sure the Treasury market is liquid and functioning fully. And if that's your new mandate as the Fed, you're going to print money to buy on the margin that part of the fiscal deficit that the foreign and private sector doesn't take up, so that you peg interest rates below what they otherwise would be. And that is a real risk that the Fed and that the country is going to have to face, I think, in the not too distant future.
All right. That's simply depressing, just because I think that's the fear I and many other people have had along this whole journey.
It is scary. It is a scary thing.
Okay, so this doesn't help the situation, but we have an administration that really wants to get borrowing costs down, right? And so, the president has been leaning hard on the Fed as an institution. We have, ton of pressure he's placed on Powell, and whatever, Powell's going to do what he can do, but he's not there for much longer. We have Mirren in there, who's pushing for not just a cut. He's always seems pushing for 50 basis points at least, if not more.
Yeah.
And now everybody is who wants Jerome Powell's job is auditioning for it, and some of the people are actually sitting on that table around the Fed right now. So let me ask you this. So first off, is Powell a lame duck chair at this point in time? Does what he wants to do, is that increasingly less relevant to the other players that are around that table?
I don't know that he is a lame duck as such. He is, however, he is less in control because of the more recent Fed governors who are in opposition to him. That's rare that you have at least three governors who are in opposition to him. I haven't seen it since Volcker. So that is, he has to deal with that, and that's the difficulty of being a chairman when you don't have everyone on the same page with you. Now, over time, and one of the issues that's coming up is if the president names Powell's successor, who he's going to nominate at least, then that will make him a little less influential. So he's I don't know that he's a lame duck yet, but that is in his future, and not too distant future is my best estimate of that for the leadership, for his leadership.
Okay. Well, the week we're recording this, the president has basically said, who knows whether it's really true or not. Trump likes to say lots of things, but he said, I've made up my mind already. And if we look at the betting markets out there, the name that is rising to the top is Hassett.
Yep.
Do you think the markets have it right here, or do you think someone else is more likely to replace Powell?
Well, for any other president, I would say the markets have it right. But President Trump may, at the last minute, change his mind, and so I don't think anyone has it firmly in place, and they won't have until the nomination is made public. And I mean, the very fact that he says he's made up his mind, but he won't announce it, tells me that he's still toying with it a little bit.
Right.
Uh,
Classic Trump. So
yeah,
basically, maybe take Hassett as the lead horse, but by no means guaranteed to win the race yet.
right. Because all the players that have been named are qualified, and but I wouldn't necessarily be surprised if it was someone other than the leading names. I mean, that's just how the how this administration tends to work sometimes. So
All right, and I'm blanking. I'm trying to look it up here in real time, but if you know it, please tell me. Okay, so he is the director of the National Economic Council for the
yes,
U.S. right now. So basically, a
yes,
high-ranking economic advisor to President Trump right now.
yes.
Um, let's assume for a moment that he gets in. He is the pick, and he is chosen. He's selected. At this point in time, your understanding of the scope of Fed history is way better than mine. I don't remember as highly politicized a situation at the Fed as we sort of have right now, with Trump beating up on Powell publicly for as long as he had, replacing Fed governors with people that are very much seem to be presidential yes men. So if Hassett now gets installed at this point in time with the same group that we have, around the Fed table here, what's the danger, do you think, of people regarding that new Fed as really just a proxy for the president, right? Meaning, like, I'm going to listen less to what the Fed chair says because the world has revolved around whatever the Fed chair said for the past couple of decades, and more just listen to the president because the Fed's going to rubber stamp whatever the president, tells it to do.
Well, of course that's a risk, but first of all, this isn't the first time that the Feds have been under this kind of political pressure, and I'll give you a couple quick examples. After World War II, President Truman very much wanted the Fed to peg rates at lower levels, even as inflation was picking up. And there was the standoff between the Fed and the president, and it was eventually resolved in what's called the Fed Treasury Accord, which allowed the, the Fed to act independently around interest rates. But the person who negotiated that was William McChesney Martin, who became the
Mhm.
chairman and was really in the Treasury. And Truman was expecting him to pretty much peg the interest rates, and Martin didn't do it. And Truman considered him a traitor for that. But he did what he thought he had to do. Again, President Johnson put an enormous amount of pressure on the Fed. Again, Martin was the one who had to resist it and had a hard time resisting it. And people will debate whether he did or not. I think he put it off at least for a while. And then, of course, you had Burns and President Nixon, and it was very political then. So this is not new. So the real test will be when whoever comes in, whether it's Hassett or whomever, the first major decision where it's clear that the administration wants to go one way and the world knows that it probably shouldn't go that way, that will be the test of whether.
That will be the tell. Okay.
Yep.
Let me ask you this about those previous examples you mentioned. I've heard about them and certainly heard about the famous, President Johnson pushing Arthur Burns up against a wall, and
No,
really just.
Martin. He pushed
Oh,
Martin up.
oh, it was Martin. I always thought it was Burns. Okay, so
No,
it
no.
was McChesney Martin. Okay,
Yeah.
so pushing him up against the wall and really sort of physically threatening him. But so I get it was political, but was it in the background or was it at the forefront that it is today?
Well, it was
Is it
now
something that was in the
that
media? Is it something the
right.
regular guy knew about? Yeah.
Well, the incident was not in the
Yeah.
press, at least initially, but the pressure was well known because
Okay.
everyone knew Vietnam and the Great Society was putting upward pressure on the debt. I mean, the debt was growing, interest rate pressure was up, so everyone knew that, and everyone knew that Martin was having a hard time resisting.
Okay. Okay. So they are comparable. Um, all right. Let's see here. Um, This one will be a little interesting. The Trump administration, like I said, it's given lip service to the debt. I don't know if we can really say it's done anything, to address it yet. I think the administration would say, well, just wait for two reasons. When they've said, look, we have focused on pushing through a really aggressive set of economic policies that we think will drive a lot of economic growth in this country. And so to a certain extent, we want to get that debt to GDP ratio moving in the right direction, right? What they have said with the one big beautiful bill that was passed was, yes, we are going to increase borrowing early, but that's going to start diminishing, and we're going to start getting the deficit under control, in later years. Now, of course, that's what every politician says about every bill, right? So there's nothing unique in that. But as you look at their policies, from tariffs to renegotiating trade deals to trying to reshore manufacturing to bringing international, trillions, presumably trillions of international capital here into the U.S., to the growth provisions in the One Big Beautiful Bill and some additional forms of tax relief and deregulation. Those all sound nice, but as you understand them from your perch, what grade would you give the Trump administration's economic policies right now, given your concerns about the long-term trajectory of the debt and the state of the economy?
Well, it's hard to grade someone when they're still taking the test.
Yeah.
And so it's difficult. I would say
but
that,
there could be policies you hate. So, and I don't know if you like or hate
well,
these, but yeah.
yeah, and the policies that I'm concerned about is the difficulty is facing the um, enormous challenges of that debt. It's not just that it's there; it's how you address it. Because two-thirds of the government of that 7 trillion, okay, is based on Social Security, Medicare, Medicaid, veterans benefits, you name it. So that leaves your options for addressing that is, can you have enough growth, enough gains in productivity to really solve, be able to provide all those benefits without having to borrow more funds or without having to increase taxes. And the promise is we will provide all these increased productivity benefits without having to increase taxes, without having to cut benefits. So how do you square the circle? How do you get that to make sense? And that's the challenge that I think still is in front of this administration. Showing and proving how you will square this circle, how you maintain these benefits, how you keep taxes low, and still solve the debt problem, solve the increasing pressure on upward pressures on interest rates, how you allow the Fed to ease rates without having inflation. Those are all questions that so far have not been explained. I think satisfactory to the public, and
Okay.
that's their challenge.
So I don't know the administration. Trying to channel my best for them, they would say, well, Tom, we're going to really grow this thing. We're going to eventually get the deficit under control. Yeah, right. Everybody says that. And then third, we're going to continue the spirit of Doge to make sure of all that mandatory spending. You're talking about these mandatory programs we really can't cut because they're written into law. It's like, okay, but there's maybe some percentage of that that's being inefficiently spent, and any savings we have there means we don't have to raise taxes to continue to pay these things. And look, Doge has, I think everybody has applauded the spirit behind it, but so far we haven't seen the savings we were all hoping to get from it, but we can all cross our fingers. I detect from you, a skepticism to say, okay, we'll just cross our fingers and believe all that's true. So here's my question for you, Tom, which is, what do you think is the most likely route here? for dealing with whatever reckoning you think is going to happen here, right? In other words, you're saying, look, I've got a lot of concerns about the unsustainability of the system, right? So when that unsustainability can't be kicked down the road conveniently anymore, what does that mean? Is that we're going to cut these benefits? The government's just going to be able to do less for its populace? Is it'll meet its obligations nominally, but it'll kill the purchasing power of the currency to do it? Is it a mixture of those two? Is it something else? What do you think is most likely here with your brutal, honest lenses on?
Well, there's a couple things that you have to think about, and that is, number one, we are the greatest economy in the world. I mean, that's our huge advantage.
Mm-hmm.
And that's a good place to be if you're serious about solving the problem. Now, the question is, are you willing to solve the problem? Number one, if you are, then you will have to think about which benefits you might cut. Do you have a leadership who can explain that? That's been done before. Do you have leadership to say, well, we're going to, tariffs are a tax. That is taxation. And is there other forms of taxation that will then further bring the deficit down more than the 330 billion annual from the tariffs? Are there other ones? So help us think through that. Or you can say, we're not going to do that. We're going to continue with the benefits. We're going to grow ourselves out of this. We don't know how yet, but we will do it. And what happens then, the deficit goes up. And it goes from $38 trillion, what it is today, at the end of a decade, it'll be easily over 50 trillion, maybe.
Right. And just to be clear, you said deficit, but you meant debt.
Yeah, I meant debt, of the total debt. The deficit will be 6% of GDP, and we'll have a debt of 50 trillion plus. And in the meantime, we'll continue to grow, but we won't grow at 3 and 4%. We'll grow at 1 to 2%.
Mm-hmm.
And we'll become less wealthy slowly over time. And that's kind of death by 1,000 cuts,
mm-hmm.
right? So we have that choice ahead of us. We just haven't made the choice yet. Which of those are we going to follow is really up to the administration and Congress. And Congress is that's the purse.
Right.
Are we going to continue to do that? And is the leadership going to address it or not? I would hope that they would say, what I call share sacrifice. We're all going to take a little bit less. Rather, for example, Social Security, it's set at age 65. Maybe it should be age 70. That would take care of a big part of this problem. Medicare, maybe we don't have as many benefits for everyone, but we still have some form of benefit. Those are things that they have to think about. Or maybe we have a marginal tax rate that is higher. I'm not sure. Taxes constrain, so you're going to pay a price. Is a temporary price or not? Those,
mm-hmm.
I mean, those are choices that are out there to be made. I just don't know in which path they're taking. It's not clear from Congress that they're taking the path that says we're going to cut back some and we're going to benefit in the long run. I haven't seen that yet. And I think that is the Congress's responsibility, and they ought to live up to it to make that choice.
Yeah. What does it strike you that we have a Congress right now that is owned by the Republican Party, who titularly are the fiscal conservatives? Yeah. Meaning, if you said, look, the Democrats are just tax and spend, and they've been in power, but they're not now. The fact that the deficit is still as out of control as it is, I mean, I understand your two paths. I just don't see a great likelihood for one of those paths, because I don't see any real credible appetite in Congress for fiscal restraint.
I agree with you. I've not seen any at all. I haven't. Now I do know within Congress, within the Republican Party, there are um, there are leaders there who know this is a problem and they know they need to address it, and they're trying to build a base for doing that. But Congress as a whole isn't there yet. It's just not there yet, and that's unfortunate because the longer you wait, the greater the problem becomes and the
Yeah.
more difficult it becomes to solve. Remember, when QE started, when I was concerned about it, the debt was maybe $10 trillion, maybe 11 trillion, 2008, 38 trillion now. And the debt's going to be 50 trillion if we don't get this taken care of. And yet no one seems to be stepping up to it in terms of enough people stepping up to it. There are some, but not enough yet.
Yeah, there are some, they're not making a difference. And you understand exponentials. I mean, the debt growth
yes,
is an exponential curve, meaning it
right.
just gets worse faster the longer it goes on, right?
And that's what's happening. And I think, and that means you take the second path of slow death. We should be growing at 3 to 4% a year. We'll be growing at 1 or 2% a year. Even this Congressional Budget Office, with all its assumptions that are very optimistic assumptions, are projecting a growth rate of less than 2%. That is unfortunate for the next generation of Americans, and that's where I think we're falling down. And it may be that generation of Americans who finally say, "I've had enough," and we have to change this.
Right.
And that's what may lie ahead. But right now we're on the slow growth rate that we will all suffer from.
Yeah, I think part of the problem is, and this is a feature that I believe is a bug of the our current form of governance, is that fiscal, what's the word? Oh gosh, I'm blanking on it. But fiscal restraint, I guess we'll say, it's a career killer, right? The politician who says, well, let's spend more to solve X problem, not only is not just more popular amongst the other politicians on DC, but he's more popular amongst his beneficiaries, among his constituency, if they're getting a share of that, right? And so the guy that's out there saying, hey, wait a minute, we need to cut benefits, we need to live beneath our means for a while because we've been living above them so much. Nobody votes for that guy, and his colleagues on Capitol Hill take out their knives for him because that's anathema to them. So you only get those types of revolutionary changes on like, okay, we're all get austerity. That's the word I was looking for. We're all going to embrace fiscal austerity once you've had some really horrible crisis, right? And one of the things that worries me, and I'm not trying to be doomy and gloomy about this, and I think eventually at some point in time we'll make the right decision here, but it may be after a lot of continued bad decisions. What I think is quite likely here is it is an expression that when crisis hits, the solutions that get implemented are the ones that are already on the table. And we've not been putting austerity solutions on the table recently. We've been putting actually, hey, let's give direct checks to households. We've really gone the other direction. So it seems to me that the next time that we're getting pinched because of our economic profligacy, we're just going to triple down or quadruple down on what hasn't been working because that's what's popular in the moment as a politician, and that's what your constituents screaming for, right? Hey, you gave us checks last time, give us checks again now.
Right.
Yeah. So do you share this sort of depressing?
I do, but yeah, I do share that. But I have to tell you another failure that happened, I think, this time. One of the reasons that the Fed is supposed to be, put in quotes, independent, at least independent of short-term political pressures, is that the founders realized that politicians tend to want to spend and worry about it later. And the idea was that we're going to make this central bank that we have now. We distrust it, but we distrust ourselves every bit as much. That is Congress speaking. We're going to make it to where it can't say no. And the Federal Reserve, I think, is part of, its failure is not in today so much as in 2010. That is, when you engaged in massive printing of money called QE, you made it easy for politicians to spend without consequence.
Absolutely.
When you push interest rates to zero and you kept them there, you made it easy for politicians to spend without consequence. And so rather than saying, wait a minute, we can't do this, it's our mandate is to maintain price stability, asset as well as general prices. And we can't be printing this money like this. We can't do QE and zero interest rates for year after year, which is what they did. And so the second part, the safety valve on this, kind of failed as well. And so we got Congress used to spending and paying for it with low interest rates, therefore able to spend even more. And that has come back to haunt us. And here we are, unable to solve the problem.
I'm going to ask you a uncomfortable question, which you can feel free to just say, I don't want to answer that. But when I talk to people who, are in the Beltway and really understand how the political system works, the number one thing they say needs to be fixed about the government is getting big money out of politics. And the fact that so many politicians are influenced by the monies that they have to go out there and raise. I mean, the majority of their time spent during the day is not lawmaking, it's fundraising.
Right.
To the point that you just made, how much of a factor in the Fed becoming complicit in not saying no, not doing the hard thing and saying, look, we're here to be the adult at the table, and saying, yeah, let's grease the wheels that everybody wants greased. How much of that, if any of it, is influenced by, what we see what happens after a Fed chair leaves their tenure and gets a really nice cushy board seat at a big financial institution, gets paid $500,000 a speech and whatnot. Is there an influence of those parties while the Fed chair is sitting in the seat doing their job, saying, all right, I know I got to keep these guys happy because I want the big golden parachute from them?
I don't think it's that direct a line. I think it's more that when you're in that chair, you're not necessarily unlike a politician. You want to be liked, you want to be admired. I think that was certainly part of Greenspan's second half of his term, perhaps. And it's hard to say no. It's just flat out hard to say no. And people, people dislike you for it, and they
it's hard to be the adult
go
at
after
the table.
It's very difficult. And I think that's a real problem. And the Fed was set up to allow for that, to better allow for that. It wasn't a guarantee, and that's why they had longer terms. But that's not a well-paid job, so you do have the post period that you think about, perhaps. But I don't think that was the driver for it. I think it's the fact that more and more of the nominees are political nominees. Even the reserve banks, there's more influence from the board of governors in the picking of the presidents. It's supposed to be a local board choice. They pick the best person for it, but there's now a lot of interaction by the board of governors to influence that decision. So it's become more centralized and into Washington as the selective mechanism. And I think that's makes it even more political than it otherwise would be. So I just think the whole nature of our system has been politicized. Now, I'm not so naive as to think we can go back to a gold standard, but when we were on a gold standard, we had an external discipline
You
brought
had a
to the
governor.
Fed,
Yeah.
and we need to bring some form of that back, not necessarily as a gold standard, but as a limit on how much, a limit on QE. I mean, that should be retired. That the ability to do that massively. There should be a limit on how much the Central Bank of the United States can increase bank reserves on an annual basis, say 2 to 4%, consistent with the real potential growth rate of that economy. It can be changed from time to time, but clear limits, not a growth rate of 20%. Because with a growth rate of 20%, you know what you're going to get. You got it. We've proven it over and over again. So we need more external governors on what the Fed can do, set out in times when it's not, I need to spend more money. The Congress needs to say, this is the limit. We know we'll be sorry we said it now, but we know it's necessary. So that's your limit. And I think you'd have a much more successful central bank and a much more successful spending fiscal policy over the long run.
Okay, I was going to ask you for reforms you'd most like to see, but I sense maybe you just answered the question there, which is to have some limiter there. In this case, it might be a statute that just says, hey, you can't increase it by more than either 2.4% or you can't increase it by more than what the economic growth is.
Right. And of course, there's always the crisis. But here's the thing. I would say in a crisis, you're allowed to go outside that for 6 months. You're allowed to print more money than that to provide liquidity into the system for 6 months. And then you have to go back.
Right.
And you do it over
maybe you
time.
can't do it again, until you've worked off all that excess.
Right. Well, or until there is till there is a mechanism that says this is an exigent circumstance, and it can't be just the chairman of the Fed saying it.
Yeah.
And, so you have to have limits around the politicians and around the Fed flexibility. It can't be just right now. It's just full on flexibility. If the Fed decides next week to do QE, it can do QE. There's no limit.
Right.
There's nothing saying you can't do it.
Got it. Okay. So I presume you'd also like Warren Buffett's idea, and I can't remember it exactly, but it's something like, if the federal budget is above a certain percentage, then every sitting incumbent isn't eligible for reelection. Right?
Yeah,
something like that.
Right. Yeah. Something that says you're accountable for this happening. But I don't know which ideas would have any chance at all. But I do think that I do think that saying here are the ranges that the Fed can increase reserves, and here is the exceptions, and they're strict, so that you do not get out of control as we've done in the last 20 years.
Okay, Tom, I apologize. I've just looked at the time. We've gone way over what I expected, so thank you for doing this. I'll wrap it up here because I know you're quite busy. But if I can just hit you with some rapid fire questions in the last couple minutes here. To your point there about reforms, I think I've asked you this question in the past, but Lawrence Lepard, who's another, he's an influencer in this space. He's actually written quite a good book recently called The Big Print. I believe he actually sent you a copy of the book because he talks about you so favorably in it. I think he says he refers to you as Braveheart, as the guy who's out there fighting the battle. But the question he wanted me to ask you was, should the Fed be setting interest rates, or should there be a market mechanism for that? Some would say it's the 2-year Treasury yield, but should that be the purview of the Fed, or should the market really be setting it?
Well, I think the reason you have the Fed is to print reserves that influence interest rates. So I don't know how you separate it out, the market.
Okay. Although
becoming,
technically,
and
correct me if this is wrong, I mean, at its most base, the reason for the Fed existing is to be a lender of last resort, right?
yes, that's what it was originally set
Right.
up to be.
So
Yes.
something that's kind
And
of
we
in the
were on the gold,
background.
right. And we
In,
were,
in,
and the Fed was on the gold standard. Yes.
Yeah, yeah. So I mean, why not have the market set rates and why not have the market be the mechanism up until everything seizes and then your lender of last resort steps in if needed?
You could do that. And this is back to my original point. If you limited the Fed to printing it bank reserves to clear boundaries, say 3 or 4% annual basis that accommodates real growth of the economy, then the market could set the interest rates. However, it would take a lot of discipline because you have and I've said, the market, the market is give and take. It's transactions, and therefore your interest rate would be more volatile.
Mm-hmm.
And you have to accept that.
Yep.
And the market, Wall Street would not like this idea. Wall Street likes low interest rates. They benefit from that, and they would fight it tooth and nail. But the fact of the matter is, you limit the ability to create reserves, let the market set the interest rate. We'd have more volatile, probably zero inflation over time.
Yeah. It's frustrating in its simplicity. Now, I'm sure there would be, lots of other issues that folks might find with it. Nothing's a paradise, but
Well, and to the point, and I know we're running late, but the idea, I mean, this whole idea that the Fed is on now an ample reserve system says we've setting reserves to this enormous size, and the Fed will set interest rates. We got it backwards. The very thing, we got it backwards. So yeah, if we correct and say, no, your job isn't to set interest rate. Your job is, here's how many reserves we can print since we're not under gold standard any longer. That's the limit. And the lender of last resort on a temporary basis only.
I hate to ask this because we're tight, but since you brought it up, I know you mentioned that it would be hard/highly impractical to return to a gold standard. If Tom Hoenig had his druthers, would you? Like, is that just a great natural governor on the system? Should we just be on a gold standard?
Well, the answer is yes, but the transition would be so difficult that's why I think if we could just get a law passed, I mean, that limits the ability to create reserves.
Yeah.
You would accomplish maybe the same thing.
I get it, but if Tom Hoenig was writing the white paper that we all had to do, would your white paper be on a fixed standard?
No, gold standard had its own shortcomings, and it was you had not just recession, you had wild swings in the market and disruptions as well. I think if you could really limit reserve creation, you would accomplish something maybe better than the gold standard, assuming, and this is a big assuming, that you stuck with it. But of course, you have to say that about the gold standard, since we go off it every time it becomes too inconvenient.
Right, but it's not the logic of the system; it's the human factor that gets us.
It's the human factor always.
All right. Well, just ending up in the human factor here, we've kind of mentioned it a few times here, but we have this K-shaped economy. I know in previous times that we've talked, Tom, that you are highly concerned about the general public. What is your current outlook on this wealth divide and the prospects of the bottom 80%? Have we seen the worst of it? COVID was bad, but we're equilibrating from it, or do you think that we are continuing down a trajectory where that wealth gap is getting wider and wider, and that bottom 80% is losing out further and further?
I think we are. I don't think we're falling off a cliff, but I think we're continuing down that path, and I think it will take a fundamental change in policy to reverse that. And I think it can be done, but we're not there yet. No. And one thing we didn't talk about that I will mention, that the idea of reducing the regulatory burden in this economy would be pro growth. Now, I don't mean eliminate every rule, but I mean get the bureaucracy simplified, get the rules, I always say simple, understandable, and enforceable, and for a good reason. I think the productivity, that would be a boon to productivity and a boon to addressing our divide, our wealth divide.
Okay.
But right now, if we keep printing money, believe me, Wall Street will win, and I don't blame them. But that's because that's where you put in the incentive. You've got to bring discipline back to monetary policy and fiscal policy. You have to.
Okay. Well, a lot of people watching are rooting for that. They're just, I think, hungry to see signs of it, which seem to be precious few at the moment. All right. Well, look, Tom, you've given me so much more time than I could have asked for. Thank you so much. It's always so enlightening talking to you, but really also, I mean this, it's such a privilege. So thank you for giving so much time to this channel.
Well, you're nice for saying so, and I've enjoyed it very much. I hope it helps. I hope it sends the right tone, not one of desperation, but one of hope. And we'll see what happens in the future.
Yeah, it's hope. And maybe next time we have you on, Tom, we can dig a little deeper into just, what should we as voting citizens be demanding of our elected officials to try to get some of the reforms you'd like to see enacted there, beyond just sort of rolling over and taking it, what should we be doing?
Well, and it will take the population saying, I'm willing to sacrifice, but we all have to sacrifice. And you're the leaders. So design a system where we can all feel that we're in this together, not one against the other. Right now it's Wall Street's over here and everyone else is down here. That's why you have this bitterness in this country against wealth.
All right. Well, look, for folks that have really enjoyed this discussion, Tom, but would like to follow you and your work and your ideas between now and the next time you come on this channel, where should they go?
Well, I'm on FinRed at the Mercatus Center, and we're on Substack.
All right. So when I edit this, Tom, I'll put up the links to those resources so folks know where to go. Folks will also be in the description below this video. All right. Well, folks, please join me in thanking Tom profusely for giving so much of himself to us today by hitting the like button and then clicking the subscribe button below, as well as that little bell icon right next to it. And if you would like to get some help from a professional financial advisor in positioning your portfolio to hopefully withstand and maybe prosper, given some of the forces that Tom and I have talked about here, if you don't already have a good one advising you, feel free to talk to one of the ones that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. To schedule one of those discussions, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple seconds to fill out the form. These consultations are totally free. There's no commitments involved. It's just a service these firms offer to be as helpful to as many people as possible. Tom, again, I can't thank you enough. It's always such a joy, and I really mean this. It's just such a privilege to have you join us as frequently as you do.
Yeah, thank you for having me.
All right, and everybody else, thanks so much for watching.
Gold's $3,653 an ounce. That old high at 3,500 is now support. Old high is now probably old resistance, probably now support. I think the next round level is 4,000. Gold ETFs, massive inflows, and there's a lot of room in gold ETFs. Just get back to the old highs. So massive inflows there, but it's a major shift. Key thing to think about gold here is here's a key risk I think for gold for then. So I think gold has a lot more room to the upside. Significant correction, it might get near 3,300, but 3,500 is first support. I think the next round number resistance around 4,000. As far as timing, the bottom line for gold to really accelerate will be if the U.S. stock market rolls over the year. I still expect gold to be one of the best performing major assets this year.
Gold is holding around $3,653 an ounce, with $3,500 as key support and $4,000 as the next resistance. ETF inflows are strong, showing a major market shift. While a pullback toward $3,300 is possible, the bigger picture points to more upside. A sharp rally is likely if the U.S. stock market weakens, and gold is still expected to be one of the year's top-performing assets. Bank of America and JP Morgan expect gold to surpass $4,000 per ounce by Q2 2026, supported by strong demand and macroeconomic factors. Mike McGlone is a seasoned senior commodity strategist at Bloomberg Intelligence. He explains that gold is driving the broader precious metals rally, with silver and platinum also benefiting. Gold is up about 40 to 45% this year, pushing ETF inflows to their highest since 2023 after years of outflows, while central bank buying remains strong. The $3,500 level has become key support. Goldman Sachs warns that gold's price could increase dramatically if the Trump administration's attack on the independence of the U.S. Federal Reserve is successful. Ray Dalio has warned that U.S. markets are risking a hard attack due to massive debt burdens. He suggests gold be used as a protective asset, advising 10 to 15% portfolio allocations because gold tends to hold value when other asset classes falter. Risks include geopolitical shocks, U.S. stock market strength, and high interest rates, but gold appears to be anticipating a reversal in equities. A significant stock market downturn could trigger the next big surge, with support around $3,500 and potential corrections toward $3,300. As we start the video, don't forget to hit the bell icon and subscribe so you don't miss any updates. We value your opinions.
They're all basically going up on the back of gold. Good example is silver. Silver and gold are both up about 45% on a one-year basis. Yet silver is known as the devil's metal for a reason. It's leveraged gold. It typically trades 2 times the volatility. On a risk-adjusted basis, it should be up 90%, but that's what's happened. Gold's pulling everything along with it, particularly platinum. In May, I think that gold-platinum ratio reached the highest ever, and platinum just kind of catching up as we're seeing that responsive buying. So everything's bottom line because of gold and because central banks are buying gold, and now ETF buyers are significant buyers of gold. The ETF total inflows have jumped up today as we speak on September 10th to the highest since 2023. It just got above that high from there then, and that's after 4 years outflows. There's a significant inflows into gold, central banks buying, and then everything I think about gold is just nothing but bullish. Obviously, that's kind of the fear when it's nothing but bullish. What stops it? And the way I like to phrase it is every time Mr. Trump speaks, gold smiles. And then, of course, there's those geopolitical things happening with wars escalating. I'm very concerned. So for now, as we speak, it's up 40% in the year about. The last time was up more than that was 1979. CPI was running 10%. Now it's below 3%. So the key thing I want to end with, Ivan, is just how we end this year. Right now, gold signaling there's major cracks in the global financial system, potentially major cracks in rapidly advancing risk assets. And I'm hoping we can get through this year without stock market volatility picking up just a little bit like it usually does. Yeah. And I think gold's anticipating that we're going to have some normal volatility pickup in the stock market. It can be very dicey. It's difficult, but I think as far as, first put some numbers on it. As we speak, it's gold's $3,653 an ounce. That old high at 3,500 is now support. Old high is now probably old resistance, probably now support. I think the next round level is 4,000. How much higher it goes, I don't know. But yeah, bull markets get stretched, and sure, it's getting stretched. But the key thing is I just checked last week is you check for what's happening with the underlying market. First of all, what's happening with future speculators. Hedge funds are not way overweight long like they've been in the past, right? They're around 33% of total open interest. They've been as high as 45% of total interest net long. These are managed money net positions. And if you combine with gold ETFs, massive inflows, and there's a lot of room in gold ETFs. Just go back to the old highs. So massive inflows there, but it's a major shift. So I look at it as a pretty enduring bull market. If I were to buy it here, it'll go down 10%. That's just the way my life works. But I think as far as responsive investors, it's a bull market. I don't give investment advice, but I think the key thing to think about gold here is, here's a key risk, I think, for gold for the end of this year. Some significant détente out of Russia, Ukraine, potentially in the Middle East. the U.S. stock market stay on a tear, has to stay on a tear because it's a competition for gold. That's why we've had 4 years of outflows, stock market on a tear. Why buy the rock when stock's on a tear? And high U.S. interest rates. And to me, this is what gold's anticipating is a potential reversion in that very expensive U.S. stock market. The VIX right now, as we speak, is 14.66. The average for the year is 20. And it actually has been going higher. It's just very low right now because we're still somewhat in a summer doldrum period. So I think gold has a lot more room to the upside. I don't think it, on a significant correction, it might get near 3,300, but 3,500 is first support. I think the next round number resistance around 4,000. As far as timing, the bottom line for gold to really accelerate will be if the U.S. stock market rolls over. I should say when, because it's just when. I just hope it's in my lifetime. I think it's going to start this year. And that'll kick in the deflationary forces that you're seeing in China. And potentially maybe in Germany and a lot of the rest of the world's cutting rates because they see what's coming.
Mike McGlone expects gold to remain one of the best performing assets this year, though their call on treasuries has been wrong. Deutsche Bank analysts say margin debt has surged, and the current stock market environment shows parallels with the bubbles of 1999 and 2007. They warn that optimism may persist, but that a sharp correction could be coming. A banking research report emphasized that gold has crushed stocks, bonds, and even Bitcoin this year, suggesting that more investors are turning to gold as traditional risk assets look stretched. Mike McGlone predicts that signs of a recession are building as unemployment edges up, job growth slows, and payrolls are revised down. Global pressures, particularly deflation from China, add to risks. The U.S. stock market is historically expensive, and any reversal could spark volatility. Gold's strength signals cracks in the system, while long bonds may eventually become the next big trade if deflation takes hold. Let's shift our attention towards the interview.
The bottom line is no one wants to see the downturn. I'll start out with how I started the year. I still expect gold to be one of the best performing major assets this year. That's been working, knock on wood, and you got one right. And I fully expect Treasury bonds to be one of the best performing assets this year. I've been completely wrong there. This is from a guy who started in the Treasury bond pit in 1988. I thought I knew that market well. So nothing like markets to humble you. I've been wrong on Treasuries for 2 years. So I think what's going to happen, my fully anticipate, we're at the stage now. I've seen this. It's worse than it was in 99 and 2007 when stock markets go up and makes everybody get involved, and you have to keep, it's a pile-on factor. And I think at some point when it goes down, it's going to go down real fast initially, and then maybe stabilize because we're so overdue for just hitting some stops like copper did. Copper dropped 20% in a few hours because it got too expensive for silly reasons, and then just runs through things. So I'm afraid the stock market's going to do that. I don't know what the trigger is going to be, but there's certain times you're supposed to be selling when they're yelling. There's this massive yelling in the market, particularly in cryptos, which I see the most froth. And I just been pointing out that Bitcoin to gold ratio has been flat for 4 years. S&P 500 total return has been flat versus gold. It's been unchanged versus gold for 8 years. The Bloomberg Galaxy Crypto Index has been unchanged versus gold for about 8 years. And gold beats everything. If the rock's beating these assets, there's an indication that you probably should be overweight the rock and underweight highly volatile speculative risk assets that are most expensive by some measures in history. Well, inflation was much higher in 2007 and early 8 when the Fed started cutting rates because of cracks in the financial system. The bottom line is unemployment rate is ticking higher, jobs are ticking lower in all measures, not just the government data, which is somewhat dicey now because of what Trump did by firing the BLS leader is, but ADP data is negative. Employment claims from the states are all tilting downward. So I think that's part of the recession that's kicking in. Now, of course, we've had this significant downward revisions in payrolls, and people have heard this from people like me before that, yeah, I was looking for a recession. My economics team was thinking next recession almost 2 years ago. It didn't happen. It's the delayed reaction that I'm most concerned about, particularly as we have a major discombobulating force, most in my lifetime, of Mr. Trump hitting hard on tariffs in the rest of the world. I mean, this has shifted the post-World War II order. So the rest of the world's seeing that, particularly in China. And you started with yields, and right now as we speak, that 10-year note yield's at 4.06%. The high was around 4.80 on the year. Just a week ago, the high in the 10 and 30-year was 5%. And I think the guide to look to where U.S. yields are going is look over at China, second largest economy. Its 10-year note yield right now is 1.82%. Severe deflationary forces in that country, and they're trying to export that deflation to the rest of the world, partly because they can't export it to U.S. anymore as much. So I think we're heading towards a normal recession. And the bottom line for everything is none of this stuff that I just said to you really matters until the U.S. stock market starts backing up. Because right now we're almost 2.3 times GDP, market cap to GDP, about $70 trillion. And GDP is 30, maybe a little bit above that. That's the most on an end-of-year basis since 1929, when Herbert Hoover was elected. So I'm afraid that Mr. Trump might just have the disadvantage of poor timing. The stock market's so expensive. We're looking for normal reversions there. And I've seen the indications from gold, certainly gold outperforming most risk assets like Bitcoin and the stock market. And I think the next big trade will be indicative of is what gold's anticipating normal deflation. I said deflation from inflation, which is normal. And that's why I think U.S. long bonds might end up being some of the next big trade. The bottom line for that is U.S. stock market has to go down a little bit, volatility pick up. And I'm prepared to get stopped out on that call by the end of the year if that doesn't happen.
Could a sharp downturn in U.S. equities be the catalyst that drives gold decisively above $4,000? With central banks steadily buying, how much higher can gold's floor realistically rise in the coming years? If you enjoyed the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us, and wait for the next updates.
The point is, we're seeing lots of silver that is being accumulated by the central banks. That's $2,225,790,000 worth of silver has come into COMEX. In the first week or so of the month, Russia, China, Saudi Arabia, let's not forget about India, who's bought somewhere between 600 and 800 million ounces over the last 5 years. That's more than is on the COMEX and the LBMA combined. Most of the public has zero idea that there is a massive drive going on for gold and for silver. First week of September, you're seeing nearly $4 billion worth of metal stand for delivery. But this is what we've seen every single month. Now, we've always been an importer of silver, not always been, in fact, never, to my knowledge, been a net importer of gold. Both of them together signal a bigger move, a bigger trend.
Central banks are quietly stockpiling huge amounts of silver, with Russia, China, Saudi Arabia, and India leading the charge. Saudi Arabia has made small but notable purchases of silver via ETFs recently, which may signal a shift in behavior. China has bought 21 metric tons of gold so far this year, 2025. It's part of their strategy to diversify away from the dollar and align reserve assets with their global status. The notion that BRICS and other developing nations are considering silver more seriously due to its dual uses is being more widely reported. India alone has accumulated 600 to 800 million ounces in the last 5 years, more than what COMEX and LBMA hold combined. The US, traditionally an importer of silver but never of gold, is now importing both, a clear sign of a much larger global trend toward physical accumulation of precious metals. Andy, the president and CEO of Miles Franklin Precious Metals, highlights that what makes today's market different is the sheer scale of physical gold and silver being accumulated, not just by investors but by central banks, with Russia allocating it in its 2025 to 2027 budget and Saudi Arabia making ETF purchases. COMEX deliveries of gold and silver remain historically high, signaling strong demand for physical metal, while a weaker US dollar is further boosting gold and drawing silver into reserve diversification strategies. Analysts like Mike Maloney see silver poised for significant upside in a potential monetary reset, though claims of India's massive silver accumulation and extreme delivery spikes remain unverified. Experts also warn that paper metals may not provide true protection in a crisis, driving the push toward physical holdings. Andy believes the public, meanwhile, remains largely unaware of this massive shift toward physical metals. As we dive into the video, Don't forget to hit the bell icon and subscribe so you don't miss any updates.
Well, I think that what differentiates this market from anything I've ever seen, Ivan, and I've been doing this now for almost 36 years, is the amount of physical demand that is being accumulated. Now, we've talked at length about the central banks that have been buying gold. We're seeing action with the central banks buying silver. Now, of course, it started with Russia saying they were going to add it to their stockpile. First time I've ever seen a government do that. And then it mitigated or moved towards China. Talking to guys like Sean Kuhn from Dolly Varden, he says, look, Andy, the Chinese, who are the second largest producer in the world, they told David Morgan they're the first, by the way, but needless to say, they're massive producers. Sean says they're flying all around Latin America, in particular places like Peru, even all the way up to Mexico, and pulling metal out of the ground before it's even called silver. They're buying doré, they're buying concentrate. They're paying double what the West will do to disintermediate the whole market, sending it back to China for refining. So you have the first or second largest producer in the world finds it significant enough to fly around the world and buy doré and concentrate right out of the ground from the miners, directly from the miners, and then sending it back to do so under the cover of anonymity, so to speak. No one really knows how much they're buying or what they're getting, but Sean can validate that is indeed what is happening. You look at the Central Bank of Saudi Arabia, disappointing as it may be that they bought huge amounts of SLV, maybe one of the worst products I've ever seen ever in my career, because just as a side note, the short position right now in SLV is 53.97 million shares,
Wow.
which is it's grotesque, it's ridiculous. And remember what the prospectus said, BlackRock said, there could come a time when there's not enough silver to cover those short positions, buyer beware. But the point is, we're seeing lots of silver that is being accumulated by the central banks. What is really different to me, as far as I'm concerned, is the amount of silver that is coming into the COMEX. And, last week I jotted down some numbers. In month to date in September, the number of contracts, and this was last week, I'm sure it's much more now, that stood for delivery was 10,599 contracts. Let's do the math real quick. 10,599 contracts times each contract weight being 5,000 ounces is 52,995,000 ounces. We'll multiply that, let's just call it by 42. That's $2,225,790,000 worth of silver has come into COMEX in the first week or so of the month. And this is what we've seen over and over and over again. The point I want to get across here is that when you have countries, Russia, China, Saudi Arabia, let's not forget about India, who's bought somewhere between 600 and 800 million ounces over the last 5 years. That's more than is on the COMEX and the LBMA combined. And now you see it happening in the United States. At this level, the people don't just have the most money that are standing for delivery. Now, when we say stand for delivery, mind you, this is going into COMEX. A lot of it leaves. A lot of it doesn't leave. So regardless if it's leaving COMEX or being put into an eligible account, not registered, meaning it's not available for sale, it's going into strong hands, to this degree, these people are not only the most well-funded traders on the planet, i.e. the central banks, the commercial banks, the very sophisticated traders that can stand for delivery on COMEX to the tune of billions of dollars every month since November, since the election, but they're also the most well-informed. And I think that's the most important thing to understand, is that the people at this level who swim in circles of 9-figure monthly acquisitions are not doing things just for kicks. They're doing it because they understand where we are going. They know the playbook. They are at the highest level of information. And that's what I take away from really where we're at this moment, is that price is relevant, but price is a tool of misdirection, allowing the big money to position before all of the people that you and I call friends outside of what we do for a living, talking about this stuff. The people who may be very smart, very bright, very well read, arguably just reading the wrong shit, and that's the problem. So most of the public has zero idea that there is a massive drive going on for gold and for silver in terms of delivery. Just as a side note, in the first 5 days or so, 6 days of the September contract, which is a non-delivery month, 3,626 gold contracts and 100 ounces apiece stood for delivery. So you're talking $1.5 billion there too.
Wow.
So in just the first week of September, you're seeing nearly $4 billion worth of metal stand for delivery. But this is what we've seen every single month. Now, we've always been an importer of silver, not always been, in fact, never, to my knowledge, been a net importer of gold. Both of them together signal a bigger move, a bigger trend, and that is that the smartest money in the world understands that there is a rush for physical acquisition of metal, bypassing the paper promises. So there you go. Crazy times, brother, and I think we're just beginning in silver.
Andy points out that central banks and BRICS sovereigns Russia, China, India, and Saudi Arabia are accelerating gold and silver accumulation, often buying ore and concentrates directly from miners, while the West relies more on paper vehicles like SLV. Russia confirmed BRICS talks on a new precious metals exchange with its own pricing, clearing, and auditing, reducing reliance on the Western system, while silver is gaining traction as a reserve asset, with reports of Russian buying and Saudi Arabia making first ETF-linked silver purchases. Analysts warn Western price suppression looks increasingly like misdirection, with BRICS building parallel commodity infrastructure to secure physical supply. Experts predict gold will remain strong, and silver could see outsized upside given its smaller market, though volatility and delivery bottlenecks may increase.
The only saving grace is, and maybe I would like to think they're not misinformed. See, if you and I bought SLV, we can never take possession. They can, because it's the amount that they purchased. You have to have a certain amount, and it's called a basket. If you are able to redeem a basket, which I don't know the exact amount, 20, 30, 40, $50 million worth, they can. So I'll give you an example. Kyle Bass, when he was running the fund for the Texas Teachers Union years ago, they bought, if I'm not mistaken, $1 billion worth of GLD. They stood for delivery. Saudi Arabia can do the same thing here. They do have the right to stand for delivery, and most of that metal, if I'm not mistaken, is held in the LBMA. So because they bought such a significant amount, they can stand for delivery. And maybe they had a reason behind doing that I'm not sure. For you and I, buying SLV is as dumb as a mud wall. Not only do you pay the capital gains for collectibles when you sell it, you can never take possession. It's custodied by JP Morgan and BlackRock. Of course, JP Morgan, as we have identified multiple times, paid the largest fine that the Justice Department had ever handed out at that point, $920 million or so, for manipulating the silver market. Well, and that was kind of, and the reason that I think that they got off so easily, I believe that this was done at the behest of the central bank, who gave them the green light to do this. And there are bigger reasons at play for holding down the monetary metals, but that's for another discussion. Simply to say, it was far more. In fact, you could argue that it was far more than just spooking. It was manipulation, and it was at one point thought it would be RICO charges, because in essence it's like the hitman kills someone, well, they can go after the mob boss because the mob boss ordered it. Well, the point of it is that who up the chain of JP Morgan understood this? Is it just the head trader, Michael Nowak, who was the sacrificial lamb that was put in jail for a couple of years? Or, I don't know. The point of it is that this is something that you can only manipulate a market, Ivan, for an extended period of time by pushing it in the direction that it is going. And I've been doing this for almost 36 years. Most of the time, the world didn't want gold and silver. They wanted U.S. bonds and U.S. stocks and real estate. They wanted what was, when things got scary, there was a rush to the dollar. What is happening now is that the big money around the world has become motivated, coordinated, and sophisticated, and they understand what's happening. The big money around the world largely being, when I say that, I'm talking the BRICS countries, in particular Russia, China, now Saudi Arabia, India, all of these countries understand, and they have been using the spoofing or the manipulation or the suppression of the metals market against us. In other words, hold the paper price down in the West and then go all around the world and drain the supplies, especially off of exchanges around the globe that don't affect the price. The price is set in the West, so if you smash the price down on paper here and then buy it up there, and there, boy, that works out well. And they're smart enough to see the big picture. That's what they're doing. And then they go as far, and just ask yourself, the second largest producer of silver in the world, the largest producer of gold, don't sell an ounce. They fly all over the world and buy gold and silver in doré, which is a crudely refined bar, in concentrate, which is a byproduct of it, right from the miners, which completely disintermediates the amount and disintermediates the market and the commercial banks. They're thinking 2 or 3 steps ahead. They're playing 3D chess, we're playing checkers. So I think that this is something that is being used against us without saying so. They get it. I'll evidence it this way. You know, I've spent a lot of time talking about the BRICS, and the BRICS grain exchange is something that is under development. And I listened to an interview about the guy who's running it a year ago, and he said, you know, we here in the BRICS produce and consume in the global south more wheat than they do in the West. Yet we have no control over its price because that is controlled on COMEX. But with the development of the BRICS grain exchange, that will change. Now, you know, they understand what we're doing with the precious metals, with the base metals. All of the things that we have suppressed for various reasons are now being used against us. It's jiu-jitsu. The premise being you use your opponent's leverage against them. And this is exactly what's happening right now, man.
Will central banks' increasing use of silver lead to a structural revaluation to that of gold? What potential effects may the establishment of a BRICS precious metals exchange have on shifting global pricing power and diminishing the importance of Western markets? If you enjoy the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.
So you're seeing retail catching the wave, which is driven by governments buying gold, right? So they have to get out of the way of the price is running, now silver's running. So that is what's going on. The question is, where's it going? And when I look, well, I mean, when is the situation with America, which is effectively saying it's on the warpath?
Right.
Yeah. I mean, China's saying, we're just growing, we get bigger and more powerful. We've got 4 times more people than you, and give us 10 years, we'll have as much money. So we'll have 4 times as much money as you. We're the superpower now. And America's going, hold on a minute. No, we're in charge here. And stop that. Stop that getting richer at our expense. No, we see you now. We know what you're doing. You're going to stop that.
Retail investors are now riding the momentum in silver, fueled by governments accumulating gold and pushing prices higher. With the market moving fast, the real question is where it's headed next. On the global stage, the US is signaling aggression as it seeks to maintain dominance, while China, with its massive population and rapid economic growth, is positioning itself to rival America within the next decade. The US sees this rise as a threat and is determined to halt China's advance, setting the stage for escalating tensions that are further driving demand for precious metals. Clem Chambers is a well-known financial commentator, author, and entrepreneur. He highlights that gold is surging because governments view it as the currency of war, a hard asset essential for defense and global power, beyond the reach of paper money or manipulation. With the US and China in open rivalry, central banks, especially China's, are buying heavily, driving prices higher. Silver, on the other hand, has always been everyday money. So as gold becomes too expensive, retail investors are piling into silver as the affordable alternative. Together, this creates a chain reaction where governments fuel gold, retail fuels silver, and institutions can't stop the momentum. For additional information, view the video. Please subscribe and like the material if you enjoy it, to receive the latest updates.
Well, hold on a minute. Gold's a bit expensive now. What? $3,500 an ounce, that tiny little fleck of gold. And silver, I can buy a sack of it. I can buy a load of old quarters from 1935. And by the way, if the world did end, I can go to my neighbor and say, see that chicken? I've got a silver quarter for you. I'll buy it. You can't do it with gold coin, can you? So anyway, the old currencies apply. But silver, see, gold back in the day was not money. It was currency. You have a few gold coins, you put them under the floorboards. It's not everyday money. You don't walk around with it. Now, if you think about gold, silver, copper, gold is for your cash, your wealth, or whatever counted for banking. Actually put it in a bank, literally, bury it underground in the corner of your house. That's how they used to do it. Silver, now that is purse money. That's wallet money. You carry that in a little sack, which you tie to your pants. Okay. Right. So you don't really lose it because it's in a purse. You might bury the purse if you're having a problem. It might split. It might all fall out. That would be a pain. But you put the copper in your pocket. That is pocket money. So you've got pot money, purse money, and you've got pocket money, right? Which is why if you go treasure hunting, you will find infinite quantities of copper because it was in the pocket and easily lost.
Right.
Yeah. So that is the hierarchy of metals. Yeah. So gold is for cashing. Silver is for high-ish value transactions. Yeah. So that's why it's retail. That's another reason it's retail. So anyway, a retail looks in and goes, look at that gold go. Oh, I'll buy silver. And that's what you're seeing now.
Right.
So you're seeing retail catching the wave. Yeah. Which is driven by governments buying gold. In the old days, your investment banks would go, hey, gold's going on a run. We're short that. We're short that. We're short that. Oh, yeah. We manipulate the price. And retail will go, oh, no, I'm losing money. I'll sell. Oh, I'll take it back. I'll take it back. And you can, and the institutions can do that with retail because retail is, there's always the frothy part of retail that is easily manipulated, but they can't do that to government. That's playing, that's wrestling Godzilla. You are going to lose. Right. So they have to get out of the way of the price. The price is running. Now silver's running. Yeah. So that is what's going on. The question is, where's it going? And when I look, when is the situation with America, which is effectively saying it's on the warpath?
Right.
Yeah. China's saying, yeah, we're just growing. We're growing. We get bigger and more powerful. We've got 4 times more people than you, and give us 10 years. We'll have as much money. So we'll have 4 times as much money as you. We're the superpower now. And America's going, hold on a minute. No, we're in charge here, and stop that. Stop that getting richer at our expense. No, we see you now. We know what you're doing. You're going to stop that. Well,
Clem Chambers demonstrates that China under Xi has shifted from cooperation to confrontation, reviving Maoist ideas, discouraging Western influence, and asserting power over Taiwan. This has fractured global supply chains, turning critical resources like rare earths and cobalt into weapons of leverage. The U.S. is responding by rearming and rebuilding industries like shipbuilding, which are essential for military strength. Strategic reserves of gold, silver, and critical materials are becoming vital as global trade routes grow more fragile and politicized. Clem emphasizes that this dynamic is reshaping geopolitics. America is pressuring Europe to rearm while also courting India to counterbalance China. Russia, though armed with nuclear weapons, lacks the economic weight to compete. China, however, is a true rival, with far more financial resources and technological capacity. The global stage is being redrawn into blocks, and for ordinary people and markets, the consequences mean heightened risks, disrupted trade, and the urgent need to secure assets in times of escalating conflict. Let's redirect our attention towards the interview.
Xi came in to China and brought back Maoism, which is not good. He said to these children, stop playing computer games, start getting fit, stop learning English, hey Taiwan, we're coming for you.
Right.
Well, that's what kind of started the ball rolling. Yeah. Now, their predecessors were much more, we'll be your friends, we'll make your plastic junk, we'll make money, and we'll all be very civilized and nice, and, we can all be friends. But Xi has taken a China exceptionalist point of view, in the same way as America takes an American exceptionalist point of view. Right. And in fact, the world needs to be more like the Europeans, who up until recently have been quite laid back. Yeah, we can get on with you. Yeah, build a pipeline. Yeah, let's all do business. Yeah, let's all be friends. Well, that polarity means that all these global supply chains are now fractured. Yeah.
Right.
So you can't actually rely on your cobalt flow anymore or your rare earths anymore. And that's the base of your economic pyramid. And whereas before they were commodities and they just got loaded up to ships and sent to wherever they needed to be, and everybody was, relatively reasonable with each other. Now it's like, oh no, you can't have your rare earth. No. We've weaponized it. No. See how far you're going to get with your business without our rare earth. Oh, cobalt. No. So now countries basically have to build up strategic reserves of all sorts of critical things. And
Right.
silver is good. You start by going, oh, the only thing we need is gold, because gold, that's bullets, and that we can buy everything we want with gold. And then you go, actually, maybe we can't. Maybe we won't be able to buy it all. Maybe we won't, if they're shipping it and they say, no, if a ship goes there, we're going to sink it. I mean, what's been going on with the Houthis? They've been firing at ships. The thing that happened also that is, I had to check up to see whether it happened, and it actually happened. Trump came out and said, if you've got a Chinese ship and you land containers, we're going to bill you. We're going to bill you 2% of the value of those containers when you land. So if you're a container ship built in China, that's a $7 million bill just to pull up at the port.
Wow.
Yeah. And that's so that people buy American ships, not that America makes many ships just yet, so that the ship industry in America will take off again. And why do they want shipbuilding in America? Well, if you can't build ships, you can't build battleships, can you? Yeah, you can't build all those Liberty ships that were built in the Second World War to ferry all that important equipment around the world as you're fighting World War III.
Right.
Oh, oops, I can't build ships. Oh, well, actually, maybe we'll build a few shipbuilding. Oh, I can't build ships because I haven't got any iron. Oh, still. Oh, no, and I haven't got any I've got no rare earths. I can't build any planes. Yeah. So that is what's driving all of this. It's basically America rearming.
Wow.
And yeah, exactly. And it's not good. It's like, okay, you could say they have to, they need to, they must. Okay, I'm not going to argue with that. But what that actually means in reality to people like us and to the markets and to the world economy and what is the denouement on that? Normally, these things don't suddenly heal themselves and everyone's friends. That is dramatic, absolutely dramatic. And that drumbeat, I mean, when they had that speech in Europe, it was like, oh no. And then you go, well, I'm just being paranoid. I'm old and I'm paranoid. Oh no, they've done something else. And every dot on the map, it only makes sense when you see it as America rearming.
Right.
And they've told Europe to rearm. And Europe is rearming. Well, that's not good. I mean, okay, forget it. Maybe it's great. I mean, maybe I'll be, old enough I won't care that there's World War III started. But maybe I'll make so much money I'll be in Chile and drinking red wine, crying, but I'll be far away. But nonetheless, it's not. I can't change that. The only thing I can do is look at it and see where there's real returns to be made to secure myself and my family. And that's how I look at it. It's, I can't. Maybe it's necessary to have World War III. It's nothing to do with me. I can't affect that in any shape or form. But there you are. There is that drumbeat. And they might stop. After all, somebody wants a Nobel Prize. Maybe China is too fragile to get into this Cold War conflict. Maybe it's Russia versus America all over again. Maybe it isn't. Whatever. But if you don't realize what appears to be going on, you don't track it. And you don't, something that is, I was relieved a few weeks ago. Trump was getting angry at India, at Modi.
Yeah, I heard about that.
Yeah, but you realize the moment America starts sucking up to India, that is very, very bad. Because in a global conflict, it's China, India, Russia, and America, and Europe, right? India is a major player. Now, they historically go, nothing to do with us. No. Nothing to do with us. Nothing to do with us. So, but if America is really accelerating, it has to make India either neutral or their friend. Because then it's China and Russia. Well, Russia's nothing. Everybody's worried about Russia. Russia's 150 million people with no money. right? China is 1 billion with all the tech that we love. I mean,
Wow.
forget Russia.
Yeah.
Russia is, not a thing really. I mean, it can nuke everybody. That's the thing it's got. But you take away its nuclear, what has it got? It's got no money. It's got hardly anybody. Yeah, 150 million people versus 500 million people, $7 million GDP versus a $35,000 GDP per head. It's like
Wow.
1/18 of the economic power of Europe,
Yeah, it's a
without
big
even
difference.
factoring America in there.
Yeah.
But China's a different matter. China's got more money, literally more cash. In dollar terms, it has got twice as much cash in dollar terms in America.
Wow.
So if you counted up, if you stacked up all its yuan, and you said that's that much of dollars, and you stacked up all the American dollars in existence out there in circulation, it's got twice as much. Yeah, you fly into Shanghai at the airport, and you fly into JFK, and you think JFK versus Shanghai airport in a battle. There's only one winner there.
In short, the world is entering a new era where gold and silver are not just investments but lifelines in a fractured global order. As nations rearm and tensions rise, precious metals are gaining renewed importance both for governments seeking power and individuals seeking protection. The momentum in these markets reflects not just financial trends but deep geopolitical shifts that will shape the decade ahead. How long can central bank demand continue driving gold and silver higher before retail investors face a major correction? Could rising geopolitical tensions accelerate a shift toward a new monetary system backed by precious metals? We'd love to hear your thoughts, so share your comments below. Don't forget to subscribe for more content and hit the like button if you found this video valuable. Thanks for being part of this journey with us.